Welcome back, best ever listeners, to the Horizon Podcast. So the Fed cut the overnight rate last week, and I just got back from Dallas, Texas, where I had some really interesting conversations with some investors, and I'm going to share some of those insights today. Incidentally, this podcast will mostly focus on apartments, although it should have some value for investors in other property types once you sit down and think about it a little bit. But first, just a reminder to join me at the Best Ever Conference on February 18th in Salt Lake City, Utah. Go to besteverconference.com and register. There is a discount code podcast10, all caps, to get 10% off. Now, I'm John Chang, and I've been active in real estate investing most of my life. And since 2007, I've led the research and advisory services team at Marcus & Millichap, the leading commercial real estate brokerage company. Now, I must mention that I am doing this podcast independently, and what I say on the show does not reflect the opinions or positions of Marcus & Millichap. So this week I may run a little bit longer than normal, just because I have a lot of information to share, and I am tossing in a lot of data. So just be ready for that. But to start, I want to touch on the Fed rate cut last week. It wasn't that big of a deal. It was totally baked into the market. The Fed cut 25 basis points. They ended quantitative tightening, meaning they're going to stop letting debt burn off of their balance sheet. That should put a little downward pressure on the longer term rates. But honestly, they had mostly gotten rid of the quantitative tightening already. So it won't have a huge effect. In response to the Fed rate cut, the 10-year Treasury did tick up a little bit, but this shouldn't have much impact on the lending climate. You know, agency debt is still in the high 4 to low 5% range. Commercial debt is in the mid 6% range. We're seeing more activity from banks right now, which is a good thing. The lending climate should continue to remain liquid. And so there's lots of opportunity to access debt. So anyway, I was down in Dallas, Texas for the Green Pearl Multifamily Forum last week. And I had a dinner with a lot of investors, and they had a lot of really good feedback and interesting questions about Dallas and the Texas markets as a whole. And the top question was, when will rent growth resume in the Texas markets? They talked a lot about slowing absorption and overdevelopment problems and the concessions. And, one of the investors said, and he came up and asked me, he says, okay, so other than Texas, what markets are outperforming? And it reminded me of a conversation I had a couple months ago when I was doing an event in Chicago. And one of the investors there said, hey, these are the best of times. We've seen stronger rent growth than we've seen in a long time. The momentum is good. Things are looking great. And it just brought this all together for me. And I said, well, I told him Chicago, and he's like, no, Chicago, no way. So I really thought I'd start to break this down. And it's really a tale of two markets, and it reiterates how investors can get caught in a herd mentality even without trying to, and that a lot of the preconceived notions may not hold true in reality. I mean, so you look at the Sunbelt markets, right? Specifically Texas, and how much momentum they've had, right? They've dominated the headlines, both from an economic standpoint as well as a real estate standpoint. It's top job creation, top population growth. All these corporate headquarters have relocated to Texas. There's been lots of appreciation. The investment returns have been great. There's a massive absorption. They've had rent growth, but they've also had a ton of development in the last few years. On the other hand, markets in the upper Midwest like Chicago have there's a broad perception that their performance is really flat, and that they've been losing population, their taxes are terrible, they're losing companies, losing jobs, marginal absorption, marginal rent growth, and so on. And these are really popular beliefs as I travel around and I talk to people who aren't active in those markets, right? People who are in Dallas, Texas, and they're thinking about what's happening in Chicago, or when I'm in Chicago and people are talking about Texas. And so I figured I would compare the 5-year fundamentals and sales information for Texas and the 4 main metros, Austin, Dallas, Fort Worth, Houston, and San Antonio, against 4 of the upper Midwest markets, Chicago, Cincinnati, Cleveland, and Detroit, right? And honestly, I just kind of picked these markets because they're top of mind for me. And I know that they also had some pretty strong rent growth recently. So I ran from the end of the year 2020 to the current forecast for the end of 2025, or sometimes I use the hard data through third quarter. And I know the end of 2020 was a little bit wonky. We were coming out of the pandemic. Actually, we were still in the pandemic and just starting to think about having the vaccines and everything that were going to bring us out of the pandemic. So it's kind of a weird basis to use, but I wanted to use something simple. 5 years is a good thing because that's a relatively normal holding period, or at least that's how long a lot of the loans are written for. And for this, I'm not factoring in expenses like insurance or taxes, and that can certainly change the math. I also didn't factor in the public policy issues like risks of rent control or the operating climate in different cities, which can also change the calculus. I'm really just kind of looking at the hard numbers here in this example that I think could cause some investors to pause and think for a moment about their strategies and how they're going about their investments. And so before I dig in here, I do want to pause for a word from one of our sponsors. Okay, so I'm back. Let's get ready. I am going to throw a lot of numbers at you. So just synthesize the pieces and the themes that I'm sharing. I know a podcast isn't really the best way to get into nitty gritty numbers because you can't really see them and feel them, but just bear with me here because I think this is pretty interesting. So as of the third quarter, I'm going to go through these, the 4 Texas markets first, and then I'll go through the upper Midwest markets. But, as of the third quarter of 2025, the vacancy rate in Austin was 6.5%, and year over year rent growth in Austin was down 5.4%. So Dallas had a vacancy of 6.1% and rent growth of negative 0.9%. Houston had a vacancy of 6.1% also, and they had year over year rent growth of positive 0.4% on a year over year basis. San Antonio had a vacancy of 7% and rent growth of negative 2.6% compared to last year. Now, so basically all the Texas markets, vacancies somewhere in the 6 to 7% range. Most of the markets except for Houston had negative rent growth in the last year. Comparatively, in the upper Midwest, as of the third quarter, Chicago vacancy was 3.4% with 7.4% rent growth year over year. Third quarter. Cincinnati vacancy 3.5%, rent growth of 6%. Cleveland vacancy 4%, rent growth 5.4%, and Detroit, of all places, vacancy rate as of the third quarter 3.6%, year over year rent growth 5.2%. So here we have these very, very popular investment markets in Texas. They have high vacancy rates, mid 6 to 7% rent growth that may or may not be negative, but it's really not good. Upper Midwest vacancy rates in the 3 to 4%, 3.5 to 4% range, and the rent growth running between 5 and 7% over the last year. Now, this may be an anomaly. I'll get to more details on that down later in the program here. But if you look at the absorption over the last 5 years, and this is huge. Austin, almost 79,000 units. Dallas, almost 137,000 units. Houston, 88,000 units. And San Antonio, almost 29,000 units, right? Tons of absorption. Lots of demand for housing down there. Upper Midwest, Chicago kind of leading the pack at 48,000 units absorbed in the last 5 years. Cincinnati, 10,000. Cleveland, 5,500. Detroit, 6,300. So this is an order of magnitude difference, right? You know, the Texas markets, little San Antonio, 29,000 units, all the way up to Dallas, 137,000 units compared to the upper Midwest where you're like 5,000, 6,000, 10,000, and Chicago, the biggest market up there, 48,000 units. So really, really big difference. But when it comes to completions, it's a whole completely different story. Again, Austin, 86,000 new units over the last 5 years. That's 33% inventory growth. Dallas, 153,000 units. That's 18% inventory growth. Houston, 90,000 units, 12.5% inventory growth. And San Antonio, 32,000, almost 33,000 units, 15.5% inventory growth. So those markets, Austin, 33% inventory growth. That's huge. Dallas, Fort Worth area, 18% inventory. Houston, 12% inventory growth. San Antonio, 15% inventory. Now, comparatively, inventory growth in Chicago, 34,000 new units, which is 4.5% inventory growth. Cincinnati, 11,000 units, about 7% inventory growth. Cleveland, 6,800 units, 4% inventory growth. Detroit, 10,500 units, 3.8% inventory growth. So while the Dallas markets are all well into double digits, with Austin way up at 33% inventory growth, 86,000 units completed compared to the 78,000 units that were absorbed. It's just huge. Whereas the upper Midwest was single digit, ranging between 3.8% inventory growth in Detroit up to 6.9% inventory growth in Cincinnati. So the point is that the amount of in-migration, the amount of job creation, and the amount of absorption, household formation required to fill all these units being completed in Texas is way higher than what's needed in the upper Midwest. Now, no surprise there. And again, a lot of people have been talking about outmigration and people moving out of the upper Midwest. That has slowed down, by the way. We've really seen that flatten out. The outmigration out of the upper Midwest has pretty much stopped for the most part. In-migration to Texas has likewise slowed down considerably. So, you really kind of have to think about how perception and reality align when it comes to these things. Now, the job creation in the Texas markets is way better than you're seeing in the upper Midwest. But the demand for housing has been stronger, but those completions have really impacted the market. And right now, as the economy has been slowing down, as job creation nationally has been slowing down, granted, a lot of the job creation that we're seeing is in Texas, but still it's slowed down a lot. And that household formation has tapered off, and third quarter absorption has really slowed down. It tapered off of the really high levels that we've seen over the last year. So a real slowdown in apartment demand nationwide as a result of the slowing economy. So let's look at the 5-year vacancy change, the end of 2020 to the forecast end of 2025. So the vacancy change in Austin over the last 5 years. So comparing the end of 2020 to what we are anticipating for the end of this year, Austin's vacancy rate is up by 30 basis points to 6.4%. Dallas is up 50 basis points to 6.2%. Houston vacancy rate down 100 basis points to 6.1%. And San Antonio up 90 basis points to 7% vacancy, right? So that's the change over the last 5 years. So most of these markets have seen an increase in vacancy. On the flip side, the upper Midwest, the vacancy rates in Chicago, down 230 basis points to 3.6%. Cincinnati down 10 basis points to 3.6%. Cleveland up 50 basis points to 4.1%. And Detroit up 120 basis points to 3.8%. It was a really, really low vacancy rate at the end of 2020. So the impact on vacancies, you can see that construction and that pace of absorption over the last 5 years, really has pushed up those vacancy rates in the Texas markets relative to what you're seeing in the Midwest. And when you look at the 5-year cumulative rent growth, okay, how much have rents changed from the end of 2020 to the end of 2025? Austin up 13.1%, Dallas up 27.4%, Houston up 25.4%, San Antonio up 15.9%. So the Texas markets up, roughly 15 to 25% in rent growth over the past 5 years. Okay, not bad. But you compare that to the upper Midwest, rents are up 50.8% for Chicago, 47.6% for Cincinnati, Cleveland up 39.8%, Detroit 31.1% increase over the last 5 years. So while the Texas market rents have grown 15, 20, 25%, the upper Midwest rents have grown 30 to 50%, depending on the metro. Now, this may partially be skewed by the pandemic and the data points on the readings, but I did scan back through there and saw that there was a huge anomaly here, that the consistent rent growth in the upper Midwest was generally outpacing what we've been seeing in Texas. So even though Texas has had all of this growth and all of this positive press and this momentum, and it just has been going gangbusters, all of the development has eroded the gains. Whereas in the upper Midwest, where you haven't had very much development at all, the momentum has driven vacancies down and rents up. So this has been really interesting because the perception as I travel around the country, the belief is that the Sun Belt has been the place to invest. That the Sun Belt has the strongest growth, and bet on the growth markets, bet on the growth markets, bet on the growth markets. I hear that over and over again. But when you look at the math over the last 5 years, and this could change, right? This could have just been some weird cycle. I honestly, I didn't dive all the way in and look at a 20-year history or anything like that. I just grabbed the last 5 years. But when you look at it, the upper Midwest has done really well. Now, again, you have a lot more policy to deal with. Your taxes are different. So when it comes to underwriting an asset and an investment, there's a lot more things to consider up in the, upper Midwest or some of the other metros around the country. I picked these 4 upper Midwest markets just because they were kind of somewhat clustered and and I think they all had a similar trend. But regardless of whether you're looking at the upper Midwest or the Pacific Northwest or the Northeast or some of the other markets, don't throw the baby out with the bathwater and think that you have to be in the Sun Belt, because the Sun Belt, better growth, absolutely. But they tend to be higher development markets and you're not supply constrained. So just think about it a little bit. Now, This next section, I'm going to share how much the average price per unit and cap rates have changed over the last few years, the last 5 years. And I'm going to talk a little bit how pricing has changed. So, again, throwing more numbers at you. I'm going to compare the end of 2020 values, prices against the prices we have for the trailing 12 months through the third quarter of 2025. That's our most recent data. So Austin, price per unit up 16.3%. The cap rate has gone up 50 basis points in the last 5 years. Dallas Fort Worth, the price per unit up 28.5%. Cap rates up 60 basis points. Now, most of this cap rate increase happened over the last year. And at some points along the way, those cap rates were really negative. They went down dramatically. I mean, in Austin, if you went from the end of 2020 into the kind of the early, first half of 21 and into 2022, cap rates were way down, but they have since come back up again, over the last year. So Houston, price per unit up 6%, cap rates up 120 basis points, and San Antonio prices up 22%, cap rates up 100 basis points. Comparatively, Chicago prices up 13.4%, cap rates up 40 basis points. Cincinnati, I went back and checked these numbers. It's kind of astonishing. There was a huge uplift for a while, but Cincinnati values up 53.8%, cap rates up 30 basis points. Cleveland prices up 36.7%, cap rates down 50 basis points, and Detroit values price per unit up 36.5%, cap rates are up 80 basis points. Now, those cap rates, pretty much cap rates across all property types and across all markets are up, generally speaking, because we've seen that huge surge in the cost of capital and the rising interest rates and the slowdown of investor activity that came as a result of that, big slowdown. So cap rates are up pretty much everywhere, but the appreciation, right? The change in the price per unit on average. And again, you get into a submarket, you drill down into a specific class of asset, you drill down into a specific property, you're going to see different numbers. I'm talking about metro averages here, but you got the Texas markets, over the last 5 years, the average price per unit is up, 6%, 16%, 22%, 28%. Comparatively, Midwest markets up 13%, 36%, 36%, and 53%. So you see that there's a difference in the trend here. And when you look around the country, you get really different numbers. And again, I talk to investors all over the country, and there's been so much emphasis on the Texas markets. And granted, they were the hottest thing in 21, 22, when the interest rates were low. All of the movement, all of the migration patterns and everything else were favoring those markets. But the developers came in and kind of wrecked it, right? There's so much development that, and I think even the developers would agree, oops, we overdid it in Austin, maybe in Dallas, maybe in Houston a little bit, maybe San Antonio. So anyway, you kind of have to look at all of the math and look at these markets over the longer term, understand the nuances of these metros before you start, jumping in with the herd and chasing it down. If everybody's talking about, what's going on in Texas, then look at some other places. Right? Look at the places they're not going, because a while ago we did a study and said, hey, look, when the capital flows to a market, it depresses the cap rates, and then the prices go up and it becomes really competitive. So you're paying more and more for a lower and lower yield. So maybe going into a market that's not in favor today and capturing that opportunity. And maybe right now that is Texas, right? Because it's overdevelopment, the performance are weak, and that is the opportunity. But you look at the Midwest and the performance almost speaks for itself over the last 5 years. Now, again, this could be just an anomalous time period and off the rails, but nonetheless, it's still something to really think about. Now, before I talk about what's on the horizon and my perspective on the longer term, I'm going to ask all of you to do me a favor. If you like this podcast, I want you to share it with some other investors, please. Right? So I have a really solid listener base. I was just looking at the numbers and it's very consistent. Number of downloads and so on. It's actually been going quite well, but share this with other investors. If you're a GP, share it with your LP, right? If you're just thinking about getting into real estate, share it with other friends that you think may be interested. If you're a long-time investor, share it with other people in your networking groups and so on. So do me a favor. Share this with other people's. Maybe post something about this podcast, The Horizon, with me, John Chang, on social media. And I really appreciate your help. So I'm going to look at the horizon as I wrap up, kind of looking out 5 years. And in context, what's happened over the last 5 years. And this is something that's been showing up on my radar screen a lot more. And, I've been active as a real estate analyst. I've been looking at markets all over the country and the industry, all the different property types for about 30 years now. And I have to say that I learn something new every day. And this, maybe everybody already knew this, but, looking at the Texas markets and comparing them to the upper Midwest, just to have an example, maybe everybody already knew this, right? Or maybe the smartest people already knew this and I'm just catching on. But it really reiterated how the hype can get ahead of the market. And the hype can drive the herd. And the herd can drive the values. So it can really have a lot more effect on the investment climate and the performance of the assets in terms of the financial performance of the properties, that these things are driven partially by the media and what we see out there in the industry. Now, again, this may be an anomaly of timing. I didn't do the huge deep dive looking back quarterly for 30 years, but I think that the stories I'm hearing from investors really, really resonated with me. And a lot of the times, because of the hype, because of the perception, we cross markets off of our list of places we want to target. We don't even dig into the numbers because everybody's saying one thing. So we assume that they know something we don't. And we add markets to our list because, our buddy said, hey, look at Dallas, it's doing great, or Austin, or whatever it is. And the problem is when all of the investors move together, that can create ripples through the market and really drive the performance in weird ways. And so those opportunities evolve and change, right? Just, in 2020, Austin may have been the best place to invest. It peaked in 21 or 22, and then the developers hit it hard and the market overdeveloped. So now it's going to take a couple of years to recover. We need to add markets to our lists to evaluate the opportunities there. I encourage every investor out there, go out, pick a market, start taking a look at some of the other metros and see if there are some that could outperform that you hadn't been considering before. And, depending on your strategy, Are you looking for cash flow? Are you looking at appreciation? How much tolerance do you have for policy risk? How much, how important is what happens with insurance rates and tax rates to you? But take a look, move beyond what you see in the headlines. And remember that the opportunities will evolve and change as new information comes available and as capital flows shift. It's really hard to predict 5 years ahead. So just rule of thumb, I know we see these 5-year forecasts from all these different sources. Just take them with a heavy grain of salt. Most of them predict out 1 year and then revert to the mean, or maybe they go 2 years, but they're not intensive studies. Nobody has a 5-year crystal ball. I guarantee it. And so be cautious with those 5-year forecasts. I know everybody wants a 5-year forecast, but really, honestly, they're not very helpful. So sit down and do your own 5-year forecast. Try to predict what's going to happen with immigration, what's going to happen with jobs, what's going to happen with tax policy, what's going to happen with rental policies. It's really hard to do. So bear that in mind. And so that's what I've got. As you're thinking forward, start looking at some new markets. Take a look, see if it makes sense. If it doesn't, toss it out. But don't toss it out before you look at the numbers, and don't jump on board a trend before you really look at the numbers and compare those markets. So anyway, thank you for joining me, best ever listeners, for the Horizon podcast. Remember to like, subscribe, and follow this podcast. And don't forget to register for the Best Ever Conference. Use the discount code podcast10, all caps. I will be back next Sunday and every Sunday with real estate insights to help you understand what's really going on in commercial real estate. So I'll see you next week. And as always, keep your eyes on the horizon.